Welcome to the Research Desk. We are examining a period in financial history that systematically dismantled every comfortable assumption the market held over the last 40 decades.
And it really was every assumption, wasn't it?
Absolutely. I mean, over the past 4 years, we witnessed the instantaneous vanishing of zero interest rate policies. We saw the violent return of structural inflation. We watched geopolitics aggressively rewire global supply chains. But most importantly, we witnessed the failure of the ultimate safety net.
You're talking about the stock bond hedge.
Exactly. For an entire generation of market participants, the foundational assumption of portfolio construction was that when equities fell, fixed income would rise. But that correlation inverted exactly when investors needed it most.
It's the classic trap. You build a model based on 40 years of falling interest rates, and you convince yourself it's a permanent law of physics.
Well, almost every great market blow-up, when you trace the causal chain back to its origin, reduces to a single catastrophic error. A model assumed the current regime would persist, and it did not. I am the advocate, and I will argue that true alpha is just mathematical regime detection in disguise, and that robustness can be structurally engineered into a portfolio.
And I am the dissenter. I will argue that every robust mathematical model is an illusion that only works inside the specific world it assumes. When the causal machinery of the real world breaks, your structural diversification shatters right along with it.
The mathematical elegance of structural engineering is incredibly seductive, though. You look at a backtest, you see the smooth compounding of returns, and you convince yourself you have conquered financial gravity.
But I stress test this view with an uncomfortable truth. Models do not exist in a vacuum. We build these brilliant, logically sound architectures based on historical asset behaviors. We assume those behaviors represent universal laws. They do not.
But they represent statistical probabilities.
Statistical probabilities based on a highly unique condition. The post-Cold War era was characterized by hyperglobalization, aggressive disinflation, and persistent central bank liquidity. That was not a permanent equilibrium state. It was a deeply idiosyncratic historical anomaly.
I disagree that it invalidates the math. The distinction between predicting the future and designing for uncertainty is the most critical concept in modern finance. Let's examine the bull case for robustness as portfolio architecture.
Lay out the architecture then. How do you design for uncertainty without predicting it?
The strongest argument for regime-aware investing is that investors can build structures that inherently survive macroeconomic transitions without requiring a perfect crystal ball. Consider Ray Dalio's all-weather framework. It does not try to guess what happens tomorrow.
It abandons forecasting entirely.
Right. Instead, the architecture splits the global economy into 4 distinct, mutually exclusive quadrants based on 2 primary variables: growth and inflation.
Growth and inflation are certainly the dominant vectors. But how exactly does the framework map those to specific assets? We have to understand the actual mechanics of the defense before we can expose its flaws.
The mechanics are beautifully logical. Growth is either rising or falling against market expectations. Inflation is either rising or falling against market expectations. That creates 4 distinct macroeconomic environments.
Walk me through the quadrants.
So if growth is rising and inflation is falling, you have a disinflationary boom. Equities thrive. If growth is falling and inflation is falling, you have a deflationary bust. Long-term treasury bonds thrive because interest rates are slashed to stimulate the economy.
And the inflationary environments?
If growth is rising and inflation is rising, you have an inflationary boom. Commodities and emerging market equities outperform. And if growth is falling while inflation is rising, you have the nightmare scenario, stagflation. In that quadrant, gold and inflation-linked bonds provide the defense.
The strategic goal being that you don't care which quadrant comes next.
Exactly. Forecasting is notoriously inaccurate because macroeconomic indicators lag and policy shocks arrive without warning. The objective is to pre-allocate risk equivalently across assets that respond favorably to each of those 4 environments.
Risk equivalence being the key term there. You're not balancing dollar amounts. You're balancing volatility.
Correct. The canonical public representation of this framework typically holds 30% in equities, 40% in long-term bonds, 15% in intermediate bonds, 7.5% in gold, and 7.5% in broad commodities. By sizing the allocations based on their inherent volatility and their environmental bias, the portfolio is never fatally dependent on a single macroeconomic outcome.
It's essentially paying an insurance premium during the great times.
Yes, this is survival with optionality. You accept slightly lower absolute returns in a raging equity bull market. You are deliberately dragging an anchor to avoid total ruin when the regime shifts. During the 2008 financial crisis, while conventional portfolios suffered catastrophic drawdowns, this architectural approach was validated.
It survived because it possessed the specific structural components required to offset a deflationary shock. I concede that. The four-quadrant map is logically beautiful. The internal math is pristine.
But you're going to tell me it's flawed.
I'm going to tell you it entirely ignores the reality that growth and inflation are not the only variables that dictate asset pricing. The all-weather model completely ignores geopolitics. It ignores the mechanics of financial repression.
How does geopolitics invalidate the fundamental pricing relationship between growth, inflation, and asset cash flows?
Because the categories of growth and inflation in your model inherently assume a free market mechanism. They assume central banks and private actors respond rationally to price signals.
Which they generally do over a long enough horizon.
But what happens when a sovereign state decides that securing a domestic semiconductor supply chain is a matter of absolute national security, regardless of the inflationary cost? What happens when a global superpower blockades a critical maritime choke point, not for economic gain, but for territorial expansion?
The model absorbs those shocks through the commodity and gold allocations.
The four-quadrant model has no quadrant for the suspension of free market capitalism. This is the philosophical critique of regime detection. It assumes recorded history offers a complete data set of possible futures.
It assumes human economic behavior is cyclical.
But the globalization-driven disinflationary regime of the 1990s through the 2010s lulled qualitative models into a false sense of security. When that condition began to fracture through pandemic supply shocks, massive unsterilized fiscal expansion, and strategic great power rivalry, the old assumptions around diversification proved fatally inadequate.
You're saying the map is obsolete.
You are attempting to navigate a completely new ocean using a map drawn for a different planet.
We must ground this abstraction in the visceral market reality of recent history. If we are testing the durability of models against the failure of regimes, there is no purer stress test than March 2020.
The moment the theoretical architecture met the ultimate exogenous shock.
Exactly. When the global economy effectively shut down overnight, we saw a sudden, violent repricing of all growth-sensitive assets. The immediate assumption from critics of structural diversification is that the models failed because the shock was unprecedented. I argue the exact opposite.
You think the model succeeded in March 2020?
The portfolios that survived March 2020 did not predict a global pandemic. They did not have an early signal on viral transmission rates. They survived because their fundamental architecture was built to absorb a deflationary growth shock without requiring a predictive trigger.
So what actually happened? Think about this for a second. From February 19 to March 23 of 2020, the S&P 500 fell roughly 34%.
Which is entirely rational. The equity market was pricing in the collapse of corporate earnings due to a global economic shutdown.
Equity risk.
The Treasury market experienced severe friction.
Friction? The United States Treasury market, the deepest, most liquid, theoretically safest sovereign debt market on the planet, literally stopped functioning. It did not just decline in value, it broke.
We need to define what breaking actually means in this context, though.
Breaking means the fundamental assumption of liquidity evaporated. During those weeks in March, bid-ask spreads on off-the-run U.S. Treasuries widened to levels typically seen in distressed emerging market corporate debt.
The selling pressure was extreme, I'll give you that.
It was so extreme that long-duration government bonds fell simultaneously with equities. A portfolio relying on bonds to offset stock losses suddenly found both sides of the ledger bleeding profusely. The traditional stabilizer at the core of your architectural logic completely failed.
But the Federal Reserve stepped in.
They had to step in with trillions of dollars of emergency quantitative easing and specialized liquidity facilities simply to restore basic market functioning. This shatters the illusion of structural robustness. If your supposedly uncorrelated stabilizer becomes perfectly correlated with your risk assets during the exact moment of maximum stress, your architectural blueprint is worthless.
The correlation flip in treasuries was temporary. It was driven by market microstructure, not a fundamental failure of the asset class's behavior in a deflationary regime. We must look at the actual plumbing of what caused that sell-off.
The plumbing is exactly what makes it fragile.
The failure was not in the all-weather concept of holding bonds to offset equity risk. The failure was in how specific, highly leveraged risk parity funds and relative value hedge funds implemented the concept. Let us walk through the exact mechanics of how these models are constructed.
Please do. Expose the leverage.
Risk parity requires leveraging the lower volatility bond allocations to match the risk contribution of the highly volatile equity allocations. When you buy a treasury bond in a risk parity framework, you do not just buy it with cash.
You pledge that bond in the repurchase agreement market, the repo market, to borrow more cash.
Exactly. You use that cash to buy more bonds, repeating the process until the volatility of your bond portfolio equals the volatility of your stock portfolio.
You engineer artificial volatility to make the math work.
When volatility exploded universally across all asset classes in March 2020, funds utilizing strict, static volatility targeting mechanisms were forced to rapidly delever.
The math demanded they sell.
The mathematical models mandated that as volatility rose, gross exposure had to fall. At the same time, prime brokers demanded more collateral. These funds had to sell whatever they could to meet margin calls.
And they sold their most liquid assets first, U.S. Treasuries.
This massive, simultaneous forced selling caused the Treasury market to temporarily freeze. But this actually proves my exact point about the hidden wildcard of regime survival. The decisive variable is not signal quality. It is funding durability.
Explain what you mean by funding durability in that specific crisis.
And portfolios that survived March 2020 did not possess a better macroeconomic forecast. They simply possessed the liquidity and the balance sheet flexibility to avoid becoming forced sellers during a temporary dislocation.
They didn't rely on overnight repo funding that could be pulled at the worst possible moment.
Precisely. They had the capacity to absorb the mark-to-market pain until the underlying macroeconomic logic reasserted itself. And it did reassert itself swiftly. Once the Federal Reserve resolved the liquidity crisis and cleared the plumbing of the repo market, Treasuries surged exactly as the all-weather framework predicted they would in a deflationary growth shock.
So diversification works as long as you have infinite time and no margin calls.
Diversification works flawlessly, provided your funding structure allows you to hold the positions long enough for the fundamental math to matter.
I will use a sailing analogy to demonstrate why relying on a temporary central bank bailout to validate a portfolio model is intellectually perilous.
I welcome the comparison. Let's map it.
A seasoned sailor prepares for an ocean crossing, not by attempting to predict the exact barometric pressure of every squall, but by preserving the integrity of the hull. They carry multiple sails, they deeply understand the displacement of their vessel, and they never take on more sail area than the keel can counterbalance.
Okay, so map this to the financial architecture.
In your risk parity portfolio, the sails are the leverage. You are raising massive sails to capture the very light winds of low-yielding sovereign bonds. That works beautifully in calm weather. But the keel, the heavy lead weight at the bottom of the boat, keeping it upright, is your prime broker's willingness to fund that leverage in the repo market.
And in March 2020, the storm ripped the sails.
The storm did not just rip the sails. The prime broker has essentially removed the keel. The boat did not just tilt. It capsized. If your hull relies on heavily leveraged sovereign bonds to balance equity risk, you are sailing a vessel with a fundamental structural flaw.
But the central bank restored the keel. The market functioned exactly as a fiat system is designed to function in a systemic crisis.
If a risk parity fund requires the central bank of the United States to act as the buyer of last resort to prevent its immediate insolvency, it is not a robust architecture. It is a fragile construction, highly dependent on systemic bailouts.
It survived the shock.
You cannot claim structural robustness if the structure requires a multi-trillion-dollar external intervention just to survive a 3-week liquidity drought. Diversification without ironclad internal funding durability is purely a fair-weather idea. It works beautifully right up until the exact moment you need it to work most.
Okay, If we accept that relying on a single dominant hedge, specifically heavily leveraged long-duration treasuries, can expose a portfolio to funding shocks, we must look at how an adaptable architecture solves this.
An adaptable architecture. You mean actively trading?
The architecture is not static. Let us examine the vulnerability of implicit bets. The critique of structural diversification often centers on the idea that these risk-parity portfolios are secretly just massive disguised bets on persistently declining interest rates.
Which they were. Falling rates over 40 years provided a persistent tailwind to the bond allocation, masking the flaws in the model.
But a truly regime-aware architecture recognizes the mathematical danger of a static duration profile and adjusts accordingly. It does not blindly warehouse 30-year bonds in perpetuity when the asymmetry of the trade turns negative.
The danger of that implicit bet was spectacularly exposed long before the pandemic. We have to look at May 2013 during what the market calls the taper tantrum.
The taper tantrum is the definitive case study of a policy shock.
Precisely. It's the perfect practical exhibit of how quickly the causal machinery of asset pricing changes and how violently duration math can destroy a portfolio. Let us walk through the exact sequence of events.
Ben Bernanke's testimony before Congress.
Yes, Bernanke, then chairman of the Federal Reserve, made a relatively modest comment before the Joint Economic Committee. He suggested that if the economic data continued to improve, the Fed might, at some future date, begin reducing the pace of its asset purchases.
He didn't even announce a rate hike?
He did not announce immediate rate hikes. He did not announce quantitative tightening or the outright selling of bonds. He merely suggested a reduction in the rate of monetary easing.
And the market panicked.
The sheer violence of the market's reaction was staggering. Within a matter of months, the 10-year Treasury yield surged from roughly 1.6% to nearly 3.0%.
We need to explain the mechanics of duration to understand why that yield move was so destructive.
I will explain the math. Duration is a measure of a bond's price sensitivity to changes in interest rates. If you hold a 30-year Treasury bond with a duration of roughly 20 years, every 1% rise in interest rates translates to an approximate 20% destruction of your principal capital.
A massive, immediate capital loss.
Exactly. So when Bernanke's mild comment caused yields to jump by 1.4%, holders of long-duration bonds suffered brutal damage. This was not a response to a banking collapse. It was not a reaction to an inflationary spiral. It was a simple, mathematically mechanical repricing of forward policy expectations.
And the mortgage-backed securities market exacerbated the pain.
The convexity vortex. As rates rose, homeowners stopped refinancing their mortgages. This extended the duration of mortgage bonds, a concept known as negative convexity.
Because the bonds were suddenly going to be outstanding for much longer than investors initially modeled.
Right. Portfolio managers who held these mortgage bonds suddenly found themselves with far more duration risk than they anticipated. This forced them to sell treasuries to hedge their massive new exposure, further driving up yields.
That structural forced selling is a crucial detail.
It is the entire point. Any strategy, any risk parity framework, any supposedly all-weather portfolio that relied heavily on long duration as its universal stabilizer suffered severe damage. The taper tantrum revealed the extreme fragility of treating sovereign bonds as a risk-free counterweight.
The fundamental pillar collapsed.
When the regime transitioned from unquestioned quantitative easing to the mere prospect of normalization, the foundational pillar of the robust architecture collapsed.
The taper tantrum was indeed a violent repricing, but it precisely illustrates the structural solution to regime transitions: shortening the hedge.
Shortening the duration.
Yes. A rigid, dogmatic implementation of a macro model will hold long-duration bonds regardless of the yield environment. They will hold them because the backtest says long bonds balance equity risk.
But you're saying a sophisticated model wouldn't do that?
A sophisticated, regime-aware implementation recognizes when the mathematical asymmetry of the bond allocation becomes dangerously skewed against the investor.
Walk me through that asymmetry.
Let us look at the math in early 2013. When yields are sitting at 1.6%, the capital appreciation potential of a long-duration bond in a deflationary shock is mathematically constrained by the zero lower bound. Yields can only fall another 1.6% before hitting zero.
So your maximum upside on that bond is strictly capped.
Exactly. However, the downside risk in a rising rate environment is massive due to the duration math you just explained. If yields normalize back to historical averages of 4 or 5%, you face catastrophic capital destruction. You are risking 30% of your capital to potentially make 15%.
The risk-reward is fundamentally broken.
The structural solution is to physically shorten the duration of the hedge. Instead of relying exclusively on 30-year paper, the portfolio manager shifts the fixed income allocation into short-duration U.S. Treasuries, such as the 1 to 3 year segment.
But short-duration bonds do not provide the same magnitude of ballast when equities fall. They don't jump 20% in price.
They do not provide the same magnitude of capital appreciation, correct. But you maintain the exposure to sovereign credit quality, you preserve the ultimate liquidity profile required to meet margin calls, and most importantly, you drastically reduce the duration risk.
Because a 2-year bond doesn't care if rates move 1%.
A 1 to 3 year Treasury barely flinches when rates rise 1%. The flaw exposed in 2013 was not a flaw in the fundamental philosophy of regime-aware investing. The flaw was static allocation dependence. It was the failure of portfolio managers to dynamically adjust the instruments they used to express the structural defense.
Dynamically adjust. Listen to what you're saying. The moment you start dynamically adjusting the duration profile based on your assessment of the yield environment, you are no longer relying on structural prepositioning.
It is still structural if the math dictates the shift.
You have completely crossed the Rubicon into active macroeconomic forecasting. You are looking at a 1.6% yield and deciding, based on your discretionary judgment, that the regime is about to shift toward higher rates. You are trying to predict the Federal Reserve.
I am assessing mathematical asymmetry, not forecasting human behavior.
This fundamentally contradicts your own premise that robustness can be engineered without prediction. If your model requires a human being to override the duration allocation just before a policy shock, it is not an all-weather model. It is a discretionary macro hedge fund wearing a mathematical disguise.
Not if the machine does the adjusting automatically. And that brings us directly to systematic factor investing and quantitative models.
The quants?
Yes, these frameworks attempt to solve this exact contradiction by removing human discretion entirely. Firms like AQR have championed the idea that you do not need a brittle, discretionary macro map to survive regime changes. You do not need a portfolio manager staring at a 1.6% yield and making a gut-level forecast.
So how does the machine replace the macro map?
Instead of mapping the world into subjective macroeconomic quadrants like growth and inflation, the systematic framework identifies specific statistical risk premia. We call these factors.
Value, momentum, carry?
Exactly. The dominant factors are value, momentum, carry, and defensive. These factors possess deep empirical evidence of persistence across decades and across multiple geographies. The theory acknowledges that while these individual factors will experience periods of significant underperformance, their efficacy varies organically by environment.
Explain how they vary.
Value-buying companies that are cheap relative to their fundamentals tends to outperform in early-stage economic recoveries. Momentum-buying assets that have recently gone up and selling assets that have recently gone down thrives in persistent trending macroeconomic states.
And carry?
Carry, borrowing in low-yielding assets to invest in high-yielding assets, performs best in low-volatility, stable conditions.
But factor rotation still requires knowing which environment you are in. How does the machine know without forecasting?
Through the profound mathematical innovation of volatility scaling. This is the core mechanic. Volatility scaling is a purely mechanical process where the position size of a given factor is sized inversely to its recent realized volatility.
Sized inversely, so higher volatility means a smaller position.
Let me explain exactly how this works. The model continuously measures the daily price fluctuations of an asset over a specific look-back window, say the last 60 days. If the asset's price movements are tight and stable, its volatility is low. The formula dictates that the model takes a massive position in that asset.
And if the price starts whipping around wildly?
As an asset or a factor becomes more volatile, as the daily price swings widen, the model automatically and mechanically reduces the exposure. As it becomes calmer, the model increases the exposure.
You are claiming this replaces regime detection.
I am claiming it captures roughly 60% of the practical benefit of regime detection without ever requiring a formal prediction about the future. It is a mathematical governor on the engine.
A governor.
It dictates that as a macroeconomic regime begins to fracture, which almost always manifests in the market as a sudden structural increase in asset volatility, the portfolio systematically shrinks its footprint in the danger zone. It deleverages precisely when the environment becomes uncertain, preserving capital for when the new regime establishes a clear trend.
The theory of volatility scaling as a universal regime filter sounds intellectually impenetrable, right up until you confront the reality of the March 2009 momentum crash.
March 2009.
Systematic models rely heavily on the momentum factor because it represents the purest expression of trend continuation. Throughout the grueling bear market of 2008 and early 2009, momentum strategies worked flawlessly.
They were following the undeniable macro trend.
Exactly. Let us look at the exact mechanics of what the momentum algorithms were doing. The models systematically shorted the most deeply distressed, highly volatile financial institutions. They heavily shorted banks that were teetering on the edge of nationalization.
And they were long the safe havens.
Simultaneously, they systematically went long the highest quality defensive sectors and certain commodities. Because the downward trend was highly persistent, and the volatility of that downward trend was relatively stable over the look-back window, the mathematical governor you described allowed the position sizing to remain massively large.
The models were heavily leveraged into a continuation of the bear market.
But what happens when the market transitions violently from a bear regime to a bull regime?
I have to admit, March 2009 is the nightmare scenario for quant models.
It is the ultimate refutation of volatility scaling as a safe harbor. In the second week of March 2009, the equity market bottomed. The Federal Reserve and the Treasury Department implemented massive backstops for the banking sector. What happened next was unprecedented.
The junk rally.
The lowest quality, most heavily shorted, highest beta stocks, the very banks and distressed companies the momentum factor was heavily shorting, exploded upward in a massive violent junk rally. Some of these stocks doubled in a matter of days.
While the high-quality longs did nothing.
Conversely, the highest quality defensive names that the models were long lagged dramatically. The correlation between value and momentum completely broke.
Because the turning point was instantaneous. The historical realized volatility that the models used for sizing was entirely backward-looking.
Exactly. A 60-day look-back window is completely blind to a one-day regime fracture. The volatility scaling mechanism had no time to adapt. By the time the trailing volatility metric spiked enough to trigger a reduction in exposure, the damage was already done.
The quants got annihilated.
Momentum strategies suffered a catastrophic crash, losing roughly 40% in a single month. Decades of steady, systematic compounding were wiped out in 4 weeks. This forces us to ask a very uncomfortable question about your architecture. Is volatility scaling a genuine regime filter, or is it merely a lagging comfort blanket?
The critique of the look-back window is entirely valid. When the regime shifts instantaneously, backward-looking metrics fail.
Faster adaptation through trailing volatility metrics is not the same thing as understanding the fundamental environment. If you try to fix the look-back window by making it shorter, say measuring 5 days of volatility instead of 60, you run into a new mathematical nightmare.
You get whipsawed.
At extreme frequencies, a self-adaptive system starts to chatter. It begins overreacting to daily market noise. It scales positions up and down aggressively based on random statistical perturbations rather than genuine structural macroeconomic shifts.
You end up paying massive transaction costs for no signal.
Faster sampling of the completely wrong historical model is still the wrong model. The momentum crash proved that the systematic strategy that works best in the old world is precisely the strategy that gets annihilated by the first violent move in the new one.
The March 2009 momentum crash perfectly highlights the specific vulnerability of lagging indicators. That failure is exactly why the quantitative finance industry has moved toward defining a clear, rigorous hierarchy of adaptation. We cannot just talk about models as a monolith. We must categorize them.
Categorize them how?
We can synthesize this entire debate into a 5-level Markov hierarchy of regime awareness. This framework, based on Markov chain mathematics, classifies exactly how different investment philosophies interact with the fundamental reality of a changing world. Let us define the stack, because this maps the entire landscape of investing.
Walk me through the 5 levels.
Level 0 is the assumption of a single permanent regime. The model operates as if the current state of the world will never change. This is fatal.
Obviously.
Level 1 is the pre-allocation to all potential regimes. This is the Dalio all-weather model we discussed. Highly robust, but necessarily conservative in its return profile because you are always dragging an anchor. You hold assets for a deflationary bust, even during an inflationary boom.
Okay, that's level 1. What's level 2?
Level 2 is the ability to detect the current regime in real time. This is where AQR's volatility scaling and adaptive factor models sit. They avoid catastrophic drawdowns, usually by reducing exposure as current conditions demonstrably deteriorate.
But as we just established with the momentum crash, level 2 is backward-looking. It detects the regime after the fracture.
Which is why the hierarchy continues. Level 3 is the attempt to detect regime transitions before they happen, capitalizing on the shift itself. This is the realm of discretionary macro hedge funds.
The Soros level.
Yes. Finally, level 4 is the holy grail. It is the continuous, high-frequency re-estimation of the full transition matrix. At level 4, the model calculates the exact probability of moving from any given regime to any other regime, updating those probabilities milliseconds after new data arrives.
Before we get to level 4, we have to talk about level 0.
To truly understand the stakes of this hierarchy, we must look at the most spectacular failure of level 0 thinking in financial history. We must look at long-term capital management.
Long-term capital management is the ultimate cautionary tale of level 0 blindness. Let us break down exactly what they did, because the plumbing is fascinating. Their stated edge was executing brilliant, mathematically precise convergence trades. The firm was populated by Nobel laureates and the architects of modern options pricing.
They would find 2 fundamentally similar assets trading at a slight pricing discrepancy.
Right. Give me a specific example of the trades they were executing.
The Treasury basis trade is the classic one.
The most famous was the Treasury basis trade. They would find an off-the-run Treasury bond, a bond issued months ago, trading slightly cheaper than a newly issued on-the-run Treasury bond of the exact same maturity.
The mathematical logic was flawless. The U.S. government backs both bonds equally, so at maturity, their prices must be identical.
LTCM would buy the cheaper off-the-run bond and short the expensive on-the-run bond. They assumed the prices would eventually converge. They executed similar relative value trades across equity markets, like going long Royal Dutch Petroleum and shorting Shell Transport.
Knowing the 2 holding companies represented the exact same underlying corporate cash flows, the assets must mathematically converge.
But the profits were microscopic because the pricing spreads were measured in mere basis points, fractions of a percent. They had to apply astronomical levels of leverage to generate meaningful returns for their investors. At their peak, they were levered 30-to-1.
Which is terrifying.
But their actual alpha, the true source of their outperformance, was not a secret mathematical formula or superior intellect. It was uncompensated regime stability insurance selling. Every single one of their trades implicitly bet that the global liquidity regime that allowed these tiny spreads to safely converge would persist forever. They assumed capital would always be rational and available.
And then, August 1998 happened.
Yes, the Russian government defaulted on its sovereign debt. The macroeconomic regime instantaneously shifted from a state of stable convergence to a global flight to absolute liquidity. Investors worldwide panicked.
They didn't care about the basis points.
They cared only about securing the most liquid assets possible, regardless of fundamental value. They blindly bought the highly liquid on-the-run treasuries and dumped the less liquid off-the-run treasuries. The pricing spreads that LTCM bet would slowly converge instead violently widened.
And with 30-to-1 leverage.
Because LTCM was levered 30-to-1, a minuscule widening of the spread wiped out their entire equity capital. Was their failure inevitable? Absolutely. When you employ that magnitude of leverage on a strategy that inherently assumes the persistence of a single macroeconomic regime, level zero thinking, your destruction is a mathematical certainty the exact moment the regime changes.
I disagree that the failure of the convergence strategy itself was inevitable. Their failure was inevitable only because of the gross mismanagement of their funding structure, not because the concept of convergence is inherently flawed. Two assets with the identical underlying cash flows will eventually converge. That is financial physics.
But you have to survive long enough to see the convergence. Had LTCM utilized Level 2 regime-aware risk models, if they had incorporated a simple volatility scaling mechanism that systematically and aggressively deleveraged their portfolio the moment the volatility of the underlying spreads exceeded historical norms, they could have survived.
But unwinding a leveraged position of that size into an illiquid market would have destroyed them anyway. They would have taken severe mark-to-market losses, undoubtedly. But they would not have faced total insolvency and required a Wall Street bailout coordinated by the Federal Reserve. The failure of LTCM was a profound failure of risk management. It was a failure to respect the transition matrix of the Markov hierarchy.
They forgot the governor.
It was not a refutation of quantitative finance. They built a brilliant engine but forgot to install the mathematical governor. This brings up a critical question regarding where the individual investor, the retail participant who is listening to this, sits within this Markov hierarchy. I argue that individual investors can effectively operate at level 1 or level 2.
You think retail investors can navigate regime shifts using quantitative techniques?
I do. They can build structural robustness using broad commodities, gold allocations, and basic inverse volatility sizing for their equity exposures. There are ETFs and mutual funds designed specifically to provide these mechanics to the public. Retail investors do not need to operate at the bleeding edge of high-frequency level 4 adaptation to survive a transition. A disciplined level 1 static allocation rebalanced annually protects them from ruin.
I push back on that assertion with maximum force, suggesting that retail investors can successfully navigate these violent regime transitions at level 1 or level 2 using simplistic inverse volatility sizing completely ignores the fundamental reality of market plumbing.
How so? The ETFs execute the math for them.
Retail investors entirely lack the balance sheet flexibility, the sophisticated execution algorithms, and most importantly, the emotional discipline to survive the temporary correlation breakdowns that institutional platforms are specifically built to weather. Let us bring this down to the reality of a normal retirement account. Think about a retail investor holding a standard 60-40 target date fund in 2022.
A classic level 1 static allocation.
Exactly. And they were entirely blind to the regime shift. When inflation spiked and the Federal Reserve began aggressively hiking interest rates, the stock-bond correlation flipped violently. Both equities and fixed income experienced double-digit drawdowns simultaneously.
It was a brutal year for 60-40.
That retail investor holding a level 1 static allocation suffered immense psychological and financial damage. They took a 20% haircut because they were implicitly trusting a model optimized for a disinflationary regime that no longer existed. Furthermore, retail investors do not have access to the prime brokerage financing required to maintain leveraged risk parity positions during a margin call.
They don't use leverage in a basic retirement account.
But they also cannot seamlessly rotate out of 30-year bonds and into short-duration instruments without incurring massive, immediate capital gains taxes in their taxable accounts, which creates a massive performance drag.
So you're saying they are trapped.
I am saying the temporary correlation flips that an institutional hedge fund views as a passing squall are, for a retail investor, a catastrophic event. These drawdowns often force the retail investor to emotionally capitulate and liquidate their portfolio at the exact bottom of the market. For the ordinary investor, attempting to manage structural macroeconomic regime transitions using delayed, lagging indicators is simply walking into a buzzsaw.
If we accept that surviving transitions is phenomenally difficult, even for institutions, we must spend significant time analyzing the practitioners who actually mastered it. This requires a profound reframing of how we view the titans of finance.
You're going to try and decompose their track records?
I submit that all recognized alpha, The legendary track records that define financial history can be structurally decomposed into regime dynamics. Let us start at the very top of the Markov hierarchy. Level 4, Jim Simons and Renaissance Technologies.
The Medallion Fund, the most secretive and successful fund in human history.
Exactly. The Medallion Fund has reportedly generated annualized returns of roughly 66% before massive fees over 3 decades. The financial media consistently frames this as the ultimate triumph of mathematical stock picking.
They think it's a predictive oracle.
They imagine Renaissance scientists sitting in Long Island building models that perfectly predict which software company will beat earnings estimates next quarter. It is not that at all. Simon's actual alpha is not prediction. It is the fastest micro-regime detection on Earth. Explain what a micro-regime is. Renaissance builds an industrial-scale data processing machine that utilizes hidden Markov models. They continuously analyze thousands of distinct, fleeting statistical patterns within the market's order book. They are not forecasting the 10-year macroeconomic trajectory of the U.S. consumer.
They don't care about the Fed dot plot.
They do not care about the Federal Reserve's dot plot. They are identifying highly localized, incredibly short-duration regimes. Perhaps they detect a specific liquidity dynamic in a currency pair that reliably lasts for exactly 3 hours. Perhaps they detect a transient pricing inefficiency in soybean futures caused by the execution algorithms of a large institutional pension fund. They identify the current micro-regime, and they exploit it relentlessly before the broader market can adapt.
So speed is their structural defense.
Speed, executed at immense industrial scale, ceases to be merely a trading tactic. It becomes a profound form of structural diversification. Because their holding periods are extremely short, often measured in minutes or hours, and their instrument universe is vastly diversified across global equities, bonds, commodities, and currencies, they are entirely inoculated against broad macroeconomic regime shifts.
If the macro regime changes, they just recalibrate.
If a war breaks out or a central bank hikes rates unexpectedly, the Medallion Fund might lose money on a few trades for a few milliseconds, but the machine instantly recalculates the new transition matrix and begins harvesting the new micro-regimes created by the volatility. Simons proves that if you can continuously recalculate the transition matrix faster than the environment changes, you achieve maximum theoretical alpha. You completely transcend the macroeconomic cycle.
Simons engineered a quantum machine to outrun the regime transition. George Soros engineered a psychological philosophy to consume it. Soros operates brilliantly at level 3 of the Markov hierarchy. He anticipates the transition. Let us deeply analyze Black Wednesday in September 1992.
Breaking the Bank of England.
Arguably the most famous macroeconomic trade in the history of capital markets. And it perfectly illustrates how fragile artificial regimes truly are. Let us explain the underlying mechanics. The Bank of England was attempting to keep the British pound pegged within a specific trading band against the German mark.
The European exchange rate mechanism.
The ERM, it was an artificial, politically engineered currency regime designed to pave the way for the euro. Soros did not possess secret insider information about the British economy that the rest of the market lacked. Every sophisticated participant knew the ERM peg was under immense fundamental pressure.
The newly reunified Germany was battling inflation.
Right, which forced the Bundesbank to aggressively raise interest rates. To maintain the currency peg, Britain was forced to raise its own interest rates to match Germany's, even though the British economy was already sliding into a deep recession.
It is the macroeconomic trilemma. You cannot maintain a fixed exchange rate, free capital movement, and an independent monetary policy simultaneously.
Precisely. Soros understood the impossible trinity. His alpha was not informational. It was pure regime transition conviction. He utilized his proprietary theory of reflexivity.
Which argues that market perceptions and fundamentals feed on each other.
Reflexivity is the idea that market perceptions and underlying economic fundamentals are not independent. They create self-reinforcing feedback loops. Soros recognized that the Bank of England's desperate attempts to defend the peg by raising interest rates to 10, 12, and eventually 15% were actively destroying the British housing market and the broader economy.
The defense of the currency was making the defense of the currency politically and economically suicidal.
The actions taken to save the regime were the exact actions guaranteeing its destruction, and Soros capitalized on the fracture.
His genius was recognizing that the artificially engineered political regime was structurally doomed, and critically, he sized the bet with massive asymmetry.
He shorted the pounds heavily.
He aggressively borrowed British pounds and sold them for German marks. He risked a predefined amount of capital, knowing that if the political peg miraculously held, his losses were contained to the interest rate differential. But if the regime broke, the upside was astronomical.
The pound collapsed, and he made $1 billion.
When the British government finally capitulated and withdrew from the ERM, the pound collapsed, and Soros made $1 billion in a single day. Soros is the apex predator of the transition itself. He does not build an all-weather portfolio to weather all seasons. He meticulously identifies the precise moment the season is about to violently change, and he applies maximum leverage directly to the fracture point.
The contrast between Simon's micro-speed and Soros' macro-conviction is stark. One relies on millions of tiny statistical anomalies, the other relies on massive, directional bets on historical breaking points. But I want to pose an even more provocative question, one that strikes at the absolute heart of traditional, fundamental finance.
I'm listening.
Let us examine Warren Buffett. The universal consensus across the industry is that Buffett is the greatest stock picker in history. He is heralded as a master of identifying intrinsic value, analyzing balance sheets, and identifying companies with insurmountable competitive advantages, or moats.
Because he is.
But does Buffett's track record actually decompose into stock-picking skill, or is it fundamentally just regime patience?
You are suggesting Warren Buffett is just a macro trader?
I am suggesting his alpha is fundamentally tied to macroeconomic regimes. Consider the mechanics of value investing. Buying cheap companies with strong cash flows reliably outperforms in early cycle macroeconomic recoveries, particularly when interest rates are falling or stable.
Value factors do have cycles.
Conversely, the value factor historically lags dramatically during late-cycle speculative momentum regimes. Look at Buffett's performance in 1999 during the peak of the dot-com bubble. Berkshire Hathaway vastly underperformed the Nasdaq. He was widely criticized as a dinosaur who didn't understand the new technological paradigm.
He didn't buy tech companies with no earnings.
But then the regime broke. In the early 2000s, as the tech bubble collapsed and the macroeconomic environment shifted violently back to favor tangible cash flows and conservative balance sheets, Buffett massively outperformed.
But that is precisely because he picked the right companies. He owned businesses that generated real cash.
No, it is because he was structurally aligned with the incoming regime. If you rigorously regress the best value investing track records across history against objective macroeconomic regime indicators, a massive fraction of the outperformance is entirely explainable by simply being heavily allocated to the value factor right before the macro regime shifted the favorite.
You're stripping away the individual business analysis.
The actual alpha was not necessarily identifying a uniquely brilliant corporate strategy at Coca-Cola or American Express. The alpha was acquiring the exact type of asset that the impending macroeconomic environment would systematically reward.
But Buffett holds these assets for decades. He ignores the macro environment entirely.
That is exactly my point about regime patience. Look at the structural plumbing of Berkshire Hathaway. Why could Buffett survive 1999 when other value managers were fired by their clients for underperforming?
Because he controls his own capital.
The answer is the permanent float from Berkshire Hathaway's insurance operations. Geico and National Indemnity collect premiums up front and pay claims later. Buffett invests that massive pool of free capital. He does not have to worry about clients withdrawing funds during a multi-year value drawdown.
The float gives him infinite duration.
He possesses the ultimate structural capital base to hold those value assets through the long, grueling periods when the macroeconomic regime is entirely hostile to the value factor. Everyone thinks Buffett's superpower is reading a balance sheet. It isn't. His superpower is holding the float of an insurance company.
You're saying the float is the entire secret?
The overarching thesis. Almost all alpha ultimately reduces to regime detection or regime survival. The alpha is not in the specific stock pick. The alpha is in identifying consciously or unconsciously the regime that makes the fundamental characteristics of that pick expand in valuation and having the balance sheet to wait for it.
I fundamentally reject that premise. To claim that Warren Buffett's outperformance is merely a byproduct of macroeconomic alignment and insurance float is to strip the agency, the intellect, and the analytical rigor from the discipline of investing.
The math doesn't care about intellect.
It reduces legendary practitioners to mere entities who were simply perfectly, accidentally aligned with historical lotteries. Yes, the macroeconomic regime provides the tailwind or the headwind. Nobody denies that a rising tide lifts all boats, but the specific asset selection dictates the magnitude of the survival and the subsequent compounding.
How does asset selection override the regime? If you buy a value stock in a momentum regime, you lose, because not all value stocks are the same.
To suggest that value investing is just regime patience completely ignores the profound differences in corporate capital allocation, balance sheet durability, and managerial competence. Those are the factors that separate a fundamentally sound company that survives a regime shift from a value trap that goes entirely bankrupt.
A value trap is just a company that failed before the regime shifted back.
If you bought Sears Roebuck instead of Walmart, no amount of macroeconomic tailwinds or regime transitions was going to save you. Sears died because of catastrophic management, not because of the yield curve. You are attempting to force a highly complex, fundamentally idiosyncratic process of business analysis into a sterile, retrospective macroeconomic box.
It is an analytical tool to understand the return stream.
This highlights the precise, fatal danger of regime obsession. It convinces quantitative investors that if they just get the macro category right, the micro details of the underlying businesses do not matter. When you reduce all of financial history to a sequence of mathematical macroeconomic environments, you blind yourself to the reality that individual assets, individual companies, and individual human decisions drive actual wealth creation. The regime map is an analytical tool, certainly, but it is entirely devoid of the fundamental reality of the territory.
As we synthesize this journey, the historical reality remains unavoidable, regardless of whether we prioritize the map or the territory. The history of financial blowups, the catastrophic destructions of generational institutional wealth, is essentially the history of mistaking a long, comfortable regime for a permanent state of nature.
We certainly agree on that.
We saw it clearly with the failure of the 60-40 portfolio in 2022 when inflation returned. We saw it with the taper tantrum in 2013 when the duration math annihilated bondholders. We saw it with long-term capital management in 1998 when the convergence regime fractured.
The graveyard of level zero thinking.
The overarching narrative is exceptionally clear. Despite our fundamental disagreements on the limits of modeling, we converge on a single vital thesis. The alpha is not in the pick itself. It is in knowing which regime makes the pick work.
Because a brilliant cash-burning growth stock in a highly inflationary, rising rate environment will violently destroy your capital regardless of its underlying earnings quality.
Exactly. Therefore, building layered structural defenses is a highly actionable framework, utilizing mechanical volatility scaling to manage risk automatically, explicitly shortening the duration of fixed income hedges when yields are mathematically asymmetrical, and systematically cutting static fixed allocation exposures. This is how you survive.
For institutional portfolios, maybe.
The ordinary retail investor can absolutely implement this architecture. They can build a portfolio that recognizes its own limitations and actively protects against the supreme hubris of macroeconomic prediction.
We agree that understanding the regime is the ultimate determinant of asset pricing. On that, there is no debate. But I respectfully yet firmly disagree that this insight translates into an actionable strategy for the ordinary investor.
It requires discipline, but it is achievable.
Surviving the violent repricing of regime transitions, the sudden evaporation of treasury liquidity, the aggressive prime broker margin calls, the terrifying correlation traps where both stocks and bonds crash simultaneously is a brutal, unforgiving game.
Which is why you use unleveraged ETF structures.
It is restricted entirely to institutional scale operators who possess dedicated prime brokerage lines, highly sophisticated algorithmic execution, and massive analytical infrastructure. For everyone else, attempting to actively navigate or bet on regime transitions is not risk management, it is concentrated dynamite.
It is better than holding a static 60-40 and hoping for the best.
It invites emotional capitulation at the exact moment when mechanical discipline is most required. The safest path for the retail investor is not to pretend they possess a mathematical machine that can actively adapt to the storm, but to acknowledge their fundamental structural vulnerability to it and position their capital with deep humility. This is the Research Desk officially signing off.